Welcome to the last bit of auditing the purchasing process. In this video, we're going to actually discuss the test of detailed transactions, account balances, and disclosures. So first, we're going to look at, again, the management assertion of completeness. And here you want to conduct a search for any unrecorded liabilities. The likelihood is that most companies will understate their liabilities, right? So one of the first things we do as an auditor is we ask management about the control activities. What do they do to make sure that every liability is recorded and every accrual is recorded at the end of the period? What is part of their month-end closing process? Then what we want to do as auditor is we want to take any large dollar items from the purchases journal or the cash disbursements journal for, let's say, a period after year end, 5 days, 10 days, 15 days. And we want to not only look at the actual date on the receiving report to the invoice, but we also want to make sure that the liability is recorded in the current period where it should be. So if it is at year end, we are actually recording that liability in year end. Then we want to actually look at those files that don't have POs, that would concern us, or receiving reports and invoices to see if there's any item in there that should be recorded as a liability that it isn't. So for the test of details, what we're looking at when we're looking at existence is here as an auditor, we are mostly concerned that we as the company have the valid obligation of the entity. So here we're looking at a sample of items and we're kind of checking them to make sure that everything in the AP file is correct and that the supporting document truly says that we owe this liability as an entity. Now, when we're doing cutoff, again, one of my favorite tests, like I said, the first 5 or the last 5 dates in the month, right here what you're doing is just making sure that every transaction is recorded in the proper period. If it should be part of year end, it's in December, let's say, or if it was received in the beginning of the year, then it's recorded in January. This is purchase cutoff, and it's usually kind of goes with the physical inventory count. As you recall, as an auditor, we must perform a physical observation of inventory. And you just want to make sure here that any returns are recorded properly as well. And now when we're looking at rights and obligations, so there's a little risk here associated with that. Maybe, some companies might have incentives to record liabilities that are not actual obligations of the entity. Normally this is not as common in audits, but it's definitely something as auditors that we should look at. And now when we're looking at valuation, here we want to make sure that the gross amount, which would be gross purchases, and then the net amount, remember we have purchases, and then we have less returns and allowances, and less any discounts. That would give us our net purchases. So here what we're looking at is our gross purchases amounts, right? That's the invoice or the net cash discount. Everything is recorded correctly, that the accruals are there depending on the nature of the expense, and everything is easy to value. So with gross purchases, we're looking at this number and we're making sure that we've deducted any returns and discounts that are available as our audit test. Then we're looking at now classification, presentation, and disclosure. Remember, the disclosure notes are part of the financial statements. As an auditor, we not only audit the internal controls and we audit the financial statements, but as part of those financial statements, the notes are pivotal. So here what we're looking at is we're trying to make sure any debits in AP, right? We would expect only cash disbursements to be a debit. We want to make sure that any segregation of short and long-term payables, this might be a balance sheet reclass, right? And so balance sheet reclass meaning that you're just going to take it from long-term and move it to short-term. And you want to make sure that every payable is recorded properly. And now we're looking at the disclosure items. So we want to make sure that we're putting the payables by category or type, by employees, trade, etc. We talked about short and long-term. Any long-term purchase commitments, that we have it fully disclosed in the notes with the schedule. Obviously, related parties is a big concern in audit, so we want to make sure we're looking at those and ensuring that they are all recorded. And if we do have quite a bit of dependence on a single vendor, that we make note of that and that costs are reported by segment if segment reporting is done by the entity. Then, after we get all this fabulous testing done, now we're looking at the audit findings, right? And so here, any identified misstatement, right, we kind of add them all together and aggregate them, and we consider That's part of our sampling risk. And then when we get to this projected misstatement, that, remember, we compare it to our tolerable misstatement. So if the projected is less than tolerable, we have evidence that, okay, the account is presented fairly. But if the projected misstatement exceeds the tolerable, now we've got to actually do an audit adjusting entry to ensure that the financials are free of that material misstatement. So keep in mind, if the projected is less than the tolerable, we're good. We don't need any entries, but if it's the other way around, then we need to propose an audit adjusting entry. So here we're looking at the tax provision and the related balance sheet accounts that we're looking at in terms of permanent and differences. So we're kind of shifting a bit now to taxes and when you should use a specialist. And remember, business combinations has recently changed under FASB. So this is just something else in terms of liabilities that we may want to look at to ensure that our financials are properly presented. And that concludes our lectures for the purchasing process. Thank you.